Welcome to the Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Roddy Snell, Asia Pacific Portfolio Manager at Baillie Gifford. Welcome to the show. And Richard Hunter of Interactive Investor.
Simon.
Welcome to the show. Roddy, Asia Pacific, it's a fairly broad area, isn't it, that covers everything from China through to what we consider much more smaller and emerging countries, such as Vietnam. What is it about the area that you think makes it so attractive for investors?
I suppose the key thing comes down to growth. Asia is probably the fastest growing region globally. Net profit's grown by about 33-fold since 1999 versus the world average of about 3 times in nominal terms. And that's likely to continue in the future, given the growth of the Asian middle class. It's going to go from 600-700 million to about 2.5-3 billion over the next 20 years, all accelerated by technology. But I think what's really exciting at the moment is that we're at a sweet spot, if you like, in the stars of a line for Asia, which is why I'm personally investing more money into the region myself. And that's because if you look back over the past 10 years, Asia's actually been in a bear market, if you like. We've only just passed the 2007 peak in US dollars, because there's been some serious macro headwinds affecting Asia. But they are now turning. So we've got synchronized global growth, which disproportionately is hugely beneficial to Asia, particularly the exporters. We've got a weakening US dollar, and we've got a resurgent China. And those are hugely beneficial to the regions as a whole, which, coupled with valuations that are at a significant discount to slower growing developed markets, makes Asia look really very attractive. So that sort of combination of growth, cyclical tailwinds, and good valuations make Asia ex Japan look really very attractive at the moment. And as I say, I put in my own money there at the moment.
Why do you think we spent that sort of period slightly shunning Asia and investing in Asia? The story about how you've got this growing middle class, these rapidly developing economies and exciting companies has been there, and there's been no shortage of people willing to tell investors about it. But they did seem to sort of shy away. Do you think that's because it's still seen as more risky, and there's been this element of perhaps safety first for especially investors in the West and the developed world?
Yeah, I think it's part of that. I mean, since sort of 2007, net profits in Asia, ex-Japan and in the listed companies have more than doubled. Yet we've seen a gradual derating of valuations across the region. And I think it's a combination of factors. Firstly, those macro headwinds I was talking about, in particular, people having concerns about China, a strong US dollar which sucks money away from the region, and weak global growth, which is bad for the export-heavy countries of Asia. And combined with that, that's meant that a lot of money has flowed into areas such as the US, and Asia's really been sidelined for a while. But I think things are starting to turn. We saw that at the start of last year. Asian numbers have been very good. The valuations look cheap, and I think it's back on the radar for a lot of people.
Are there any areas in particular within the region that you really do like the look of at the moment?
We like a lot of the areas across Asia. I mean, China would be the biggest absolute position, but I think the most exciting area would probably be Vietnam at the moment. So that's about a 13 or 14% position for the fund at the moment, and that's probably the most exciting structural growth story across Asia, ex-Japan, and indeed all of the emerging markets.
And why is that, particularly for Vietnam?
I think the main reason is if you look at emerging markets generally, the sad truth is that most emerging markets never emerge. The only ones that actually ever do or have, you can count on one hand almost. China, South Korea, Taiwan, Hong Kong, arguably Singapore. And they've all had one thing in common. They've built up a successful export manufacturing base. Other countries, if they're going to fund a domestic growth story, have either relied on cyclical commodity prices or cheap foreign financing, which comes and goes. So you need that stable export manufacturing story if you're really going to emerge. And the sad truth of the past decade is that most of Asia has been in an export recession. Only really Vietnam has been able to successfully build an export manufacturing base, and it's seen export manufacturing absolutely surging. And that's a fantastic foundation for growth. Combine that with some great businesses growing about 20% per year at cheap valuations, about half the valuations of the rest of the region, and we think it's probably one of the best places to invest over the next decade in Asia.
And is it true that Vietnam is benefiting somewhat as China goes more up market? So obviously I think that lots of people have the perception China just, knock out as much stuff as you can, flog it cheap to the rest of the world. And that's not what's really going on in China at the moment, is it? China has been trying to notch itself up the quality level and really invest lots of money in sort of R&D. I mean, if you look at things such as the car industry there, electric cars, things like that. Whereas Vietnam is picking up some more of the business that China used to do in terms of being that export-driven country that can get stuff made cheaply.
Yeah, absolutely. You've hit the nail on the head. China is moving up the manufacturing value chain, and R&D is an interesting one. China's going to surpass the US in R&D spending probably this year. And Vietnam is the big beneficiary of that, because as China moves up the manufacturing value chain, there's about $2 trillion worth of low-end manufacturing up for grabs across Asia. And the only country really placed at the moment with all the infrastructure ready is Vietnam. So this is a fantastic growth story for a country that had about $170, $180 billion of exports last year. A $2 trillion market opportunity for Vietnam.
So what kind of companies do you go looking for in Vietnam, and how do you go about finding the ones that you think are worth investing in?
Yeah. So I mentioned earlier that Vietnam's cheaper than a lot of other markets. And part of the reason for that is that there's a lack of liquidity in the market, and it's quite difficult for foreigners to buy stock. There are foreign premiums if you want to. So the opportunity set is actually a little bit limited in Vietnam. So the first way we invested into the country was through another fund, an investment trust. But subsequently we've been buying individual stocks. So we've got about 8 or 9 individual investments, and it's about 13 or 14% of our portfolio. And they're really across a spectrum of industries, from banks to plastic manufacturers. What we're really looking for is growth. So the key characteristics of all those Vietnamese holdings is that they're growing very rapidly, yet not priced at the same price as the rest of Asia. But the market's opening up. That's what's really exciting. We've got a lot of privatisation happening in the state sector, and those foreign ownership levels are being removed. So cheap valuations and a market that's opening up.
And do these companies, obviously, the world of modern technology, things move on very rapidly, don't they? Do these companies, even though they are now doing that sort of lower-end manufacturing, also have the ability to tap in to the technology that we have nowadays and do it that bit more efficiently, and just sort of make that bit more of it? Is that what you're seeing?
To an extent. I mean, I wouldn't overplay the extent of the manufacturing in Vietnam. It's still very much the assembly, if you like, of mobile phones, some autos, a number of electronics. So it's the likes of Samsung and Hyundai in South Korea would be good examples of moving manufacturing plants over to Vietnam. But they're going in with brand new factories with a lot of robotics. So yeah, they are more efficient than what we're used to, but it is still at the lower end, which at that stage of development is actually really what you want, because it employs people and gets money out into the economy.
Mm-hmm. What about India? Is that an area that you look at? Because obviously, not dissimilar to China, you've got the urbanisation, ruralisation story, possibly the emergence of a middle class. But set against that, of course, we're reading on a daily basis about just ingrained corruption. Is that something that plays into your thinking when you're looking at the likes of India?
Yeah, India's an interesting one, because we do have significant holdings in India. But the reason we like India is really stock specific. It's because it's got some great companies. And what I mean by that are companies with very high returns that we think are sustainable for many years. And in many ways, the reasons why those companies exist is because of the problems of India. The bureaucracy, the corruption, the lack of infrastructure. It means it's very hard for multinational companies to come and set up, yep. And it's also hard for local competitors to start up in the country. So they've got a very strong competitive edge. But on a broader level, looking at India, I think it does have some quite serious structural problems. So I don't think, for example, India is going to do what China has done over the next 10 to 15 years. Certainly politics have improved in the country, with Modi and his party coming with the majority, and they've got some good things done, various tax reforms and a bit of infrastructure spending. But what India really needs to do, which Vietnam is doing at the moment, is setting itself up as a successful manufacturing exporter. And it should be excelling at that, and it's what it needs to do if it's going to employ the 10 million people that come into the workforce every year. But the problem with India is it just can't get things done. And for all the good that Modi's done, he still doesn't control the upper house, the equivalent of the House of Lords, so it's very difficult to pass legislation. And India's made up of 28 very large states that you can't necessarily control from the centre. So it's still quite difficult to get this giant democracy to really get the things done that it needs to, in particular changing land laws and labour reforms. And until those two big things happen, I think India is a very interesting place, but it's not going to do as well as China has over the next couple of decades.
With the pickup that we've seen in Asia-Pacific markets, so it's not completely across the board, but there's been a rising tide, hasn't there, over the last year and a half. Has that taken an area that did look pretty cheap on valuation terms and made it more expensive? Is that a concern for you?
Sure. I think you can still say that, on several metrics, it still looks really very good value. If you compare it to developed markets, which are growing more slowly, Asia ex-Japan is still on a clear distance. It is worth putting it in perspective. As we mentioned earlier, Asia has been in a bear market. So yes, 2017 was a good year, but we're really playing catch up to the rest of the world. Plus, macro factors look a lot better for Asia ex-Japan, and we're starting to see a broadening of the opportunity set, if you like. So for the past 5 years, we've been quite cautious on large parts of Asia. We've been very focused on the consumer and technology, and we've been pretty concerned about areas of, say, ASEAN, like Indonesia, given large current account deficits and a potential weakness in the currency. But we've seen big adjustments across Asia over the past couple of years. So in Indonesia, the currency's come off 50%, and we're starting to find attractive investment opportunities back into areas that we haven't been invested in for several years. So in Indonesia, we started to buy some of the banks again on a little over 1 times price to book, very cheap compared to history. In China, with the economy looking far more stable, we started to broaden out away from just technology stocks. We bought our first bank for several years, again, nearly 1 times price to book for one of the best consumer banks in the region. So I think for individual stocks, there are actually some really very cheap companies still out there. And even some of the technology stocks we've owned that have done very well, the likes of Hynix or Samsung Electronics, that make semiconductors. These are companies growing 15 to 20% per year, but still trading on 4 to 7 times PE multiples. Very cheap.
You mentioned that, and you're certainly not alone, the region Asia ex-Japan. For the benefit of the viewers, are a lot of these funds ex-Japan because Japan is a strong enough economy to stand up on its own and therefore invest in, or is it because Japan is so much of a drag on the region in general that it's, generally speaking, an area that investors avoid?
I suppose part of this has been historic. Japan was one of the most, always, arguably, up there with being the most advanced economies globally. And historically, people wanted to get exposure to emerging Asia, and in order to do that, they stripped out Japan, and that's how it settled for quite some time. Now, when you look at Asia, you could say, well, you've also got South Korea and Taiwan. Are they not arguably on par with China, with Japan? And yeah, there are questions there. It'd be interesting to see how the index evolves over the coming years.
And I suppose there's then the other element of China and how much of a chunk of sort of Asia Pacific that China makes up, isn't it? Can you see the Chinese authorities managing to navigate their way through this sort of slightly tricky path that they've got at the moment? They seem to be doing a reasonable job of it, but are there still things that could undermine that, do you think?
Yeah, I mean, what's interesting about China is just how bearish people are. This has been the most successful economy, bar none, in terms of speed and scale of economic change over the past 40 years, arguably the world's ever seen. Yet people are always saying the country's about to have a hard landing. But we should remember the bears have been wrong for 40 years on China. Now, that's not to say they don't have issues. Debt would probably be the biggest issue at the moment in China, and the government will have to be careful how it navigates that. But I don't think we're anywhere close to having a hard landing in China. Firstly, debt levels aren't actually that high for a country of China's level of development. 250% of GDP, loans to GDP, particularly given the high savings rate. Total financial assets, about 400% of GDP, less than what we have in the developed markets, developed world, about 600%. And even areas that people are really worried about, like shadow banking, 150% of GDP. In the UK, we've got about 300% shadow banking to GDP. The issue China has got is the speed and scale at which debt accelerated. So there will be some problems in the market at some point in terms of non-performing loans. But let's not forget, China has huge amounts of financial firepower to deal with any of these issues. What happened was the state banks lent to some state companies. But the Chinese government is the most solvent government arguably in the world. Unlike the West, where government simply put on the printing taps and took on all the debts onto their own balance sheets, China hasn't done any of that.
So
Government debt is about 20% to GDP.
and in that kind of command economy, is in a much better position to try and unpick any of those problems.
Oh, absolutely. I mean, it controls the state-owned banks, it controls the companies they were lent to, and it's arguably the most solvent government in the world. I mean, don't forget that China owns all the land. So the Chinese government owns all the land in China. That's probably about $25 trillion worth of assets that no one ever talks about. Total debt, any debt issue, maybe $6 trillion in China. There's huge financial firepower. And don't forget, debt crises only ever happen ultimately when there's a funding issue. And China is miles away from having a funding issue. The banks are all deposit-backed, effectively. And China itself has a closed current account. It can get away with a lot more than other countries can. And it's got this huge, incredibly solvent government. I just cannot see, in the next several years, China having a serious issue with the debt. The bigger issue will be whether it carries on expanding at the level it has been. But if you look at what's been happening recently, particularly in the last Party Congress, it looks like it's getting its house in order.
So don't write it off that yet then. Roddy, that's all we've got time for. Thank you very much. Richard, thank you very much. And thank you very much for watching. Goodbye, and join us next time on The Investing Show.